Welcome back. It has been a very volatile week with the markets. The FTSE 100 is down 4.61%, the FTSE 250 is down by 4.91%, and my portfolio has actually stopped its underperforming streak by only dropping by 3.43%. Today I'm going to be talking about my holdings, which stocks I bought this week, and the share tip of the week. But firstly, there's the three top topics of the week to get through, starting with Royal Dutch Shell. They'd announced this week that they are in fact actually growing upon their dividend. Obviously back in April, in the midst of the pandemic, they had actually cut their dividend, but this week they had said that they are going to grow it. And this is because that they had stated that their free cash flow and performance had been steadily increasing and that they are confident that they are able to pay this dividend. Whilst I really dislike companies that continue to pay a dividend whilst loss-making, in the case of Shell, it's going to make a very immaterial impact to the balance sheet and really isn't that much of a big deal for them, providing they are correct and believe that they will become profitable once again later in the year. However, as you know, I really do not like investments as of Shell, and if you're interested into why I do not like Shell as an investment, then I'll leave a card at the top right of the video for you for later. Next up, we have Deltic Group, which you may have not heard of before. This is because it's a private company. They are the UK's largest nightclub operator, operating over the brands of either Prism or Oceana. Basically, what they had done is they had stated that since they've got no help or support, which is the industry that's had no support since the lockdowns in March, that they are actually burning through £1 million in cash per month, and they've not had any allowance to reopen or anything. So what they have said is that they're going to, so they've started the sale for their business and they've had over 10 potential bidders. But I wanted to bring this up because it really demonstrates how the hospitality sector is very much on a thread. Yes, I'm very much sure that this company has not been allowed to be open, and obviously that's why they are struggling. But we are very much being propped up by the government, and further lockdowns could very much destroy the hospitality industry. Therefore, I feel that whilst the damage won't be permanent, it will certainly be long lasting. And therefore, if you're interested in these companies, there may be a buying opportunity, especially for the pub stocks, for example, in the next few months. However, for the time being, I would probably avoid them. Lastly, we have Lloyds Banking Group, which earlier in the year, for the 3 months to June, had lost £676 million, yet had announced this week that they are actually in fact in profit of £1 billion in pre-tax money. This suggests to me that perhaps the banking sector has already undergone the most difficult part of the crisis, and this could allow them to start generating some serious cash. Even with a second wave on the way, I doubt they will have to put aside as much cash, and I do believe that dividends could be being resumed very soon. In terms of Lloyds, they had spoken about this and they had said that shareholders, whilst that's the most important thing they are looking for, this will be a discussion with the board later in the year. However, if you are looking for some direct exposure to the UK economy and property ladder, then perhaps Lloyds could be a decent stock, in my opinion, for you. Whilst yes, they have done terribly over the last few years, if you feel that this trend will actually reverse and it will start to climb, then they could be a good way to get exposure to our economy and property market. Once more, very much like last week, I've not had a stock that's actually been a gainer, but rather the stock that has performed the least worse, and that stock this week is the London Stock Exchange Group. However, I do feel that this is kind of unfair because in the last week beforehand, they dropped quite a considerable amount. Regardless, they are quite a low volatility stock, and despite the general markets dropping, they had only dropped by around 1.96%. Typically, London Stock Exchange Group rises and falls with the markets, although this week I very much suspect it's just because it's reached a level in which investors are more willing to purchase this stock, as it could be seen as a higher value than it certainly has been in the last 3 or so months. I feel that they are a fairly good value at this price, and in fact I would be buying at this certain level, especially with the idea that the Refinitiv acquisition can be coming very shortly in the next year. On the flip side, the biggest faller this week was another stock listed in the FTSE 100 that rents equipment to certain industries such as construction, agriculture and industrial sectors. This company is Ashtead Group. AHT had actually fallen by 5.88%. This is due to their exposures. They are heavily exposed to the US, Canada and the UK. This means that as the US sentiment lowers with the election upcoming and potentially a third wave incoming for the US, there's a lot of fear in the markets, and that's why Ashtead Group has been priced down accordingly. And I think if it continues to drop any lower, then it could be an excellent buying opportunity. Before talking about which stocks I've actually purchased this week, I'd like to talk about my deposits and also the ISA allowance. So each and every week, as you'd already likely know, I deposit £125, but then additionally I will top up more as and when. And likely you may be surprised to hear that this week, despite the dip in the markets, that I've not topped up any additional amount. This is because I'm working towards building up my cash, and this is in a few different stages. Firstly, I need to build up my personal emergency fund because I am very much not confident on the outlook on the hospitality sector, as I mentioned earlier, and therefore feel that there is a chance I could be made redundant in the next 6 to 12 months. Therefore, since I have this time frame available to me, I figure it's a good idea to really bump up that emergency fund just to make sure I've got all bases covered. As at the moment, I still have 95% of my net worth invested, so it's not really like I'm missing out on much of the market performance. But I'm also investing my YouTube income, and what I'm doing with this at the moment is just building up my business emergency fund. This means if the camera, perhaps my computer or something breaks down, I can therefore buy a spare one without having to dip into my personal money or even sell investments for it. This effectively means that I've got that base covered, and hopefully from the end of next month onwards, the remainder of that cash I could then push towards and invest in my portfolio. And then I'm also building a small cash pot for the sidelines I can build up for investments. This will basically be where I'll put in additional money when there are lower value opportunity moments. However, for the moment, I feel that this dip may worsen. I feel that we haven't seen the beginning of this, and this could potentially be another crash. Although I'm not going to be hedging all my bets on this, and I'm not going to sell all my positions and cash out, because that's ridiculous and I can't time the market. What I will be doing is staying invested, but at least allowing this cash to build up, so that if the markets do drop 5-10% further than they are now, I should be able to get in some decent bargains with a decent amount of cash. Therefore, I'm hoping that once I'm able to achieve these cash goals, that this money will go towards building this cash pot for my investments, and therefore hopefully I can invest as much as I can save. Lastly, this may interest you, but I've got a secondary portfolio in a general investment account, and I will be revealing this at the start of December along with my income streams, including my YouTube income. And so if you're interested in this, don't forget to subscribe so you don't miss out. Don't worry, this is a very small sum, like very small sum. I'm just building up casually as I hope to build a second income stream from this portfolio in the very long term. This week I had bought 2 different stocks, and the first one may be a little bit surprising. This week I had actually bought more London Stock Exchange Group. I know that last week I trimmed 80% of my position, and at the moment I feel that now that it's dropped an additional 8-9% since I had sold it, that now could be a good time to just start rebuilding this position. Furthermore, they're not paying a dividend until May next year, so I've got time in which I will not be missing out on any of my dividend income, and I can rebuild this position slowly and securely over the next few months. Furthermore, the Refinitiv acquisition is expected to be completed by the first quarter of 2021 financial quarter, meaning that I've still got a good time frame to slowly build this position back up to where it was, but allows me to have freed up that cash which I used to invest elsewhere at the time. I now own 4 shares with an average cost per share of £84.30, which I think is a strong enough spot, and this position will be rebuilt up alongside some others in the future. And if you're interested in buying stocks for yourself, then why not sign up to Trading 212 using my link in the description down below to get a free share worth up to £100. At that point, you could just cash out the free share and then buy stocks and really bump up the start of your portfolio in the early stages. The other stock that I had been buying this week, which probably isn't a surprise, is SoftCare. SoftCare have had reduced investor sentiment since their earnings update earlier in the month, and basically they had a gloomier outlook for the future. They haven't done so well, but they're saying that they may not do as well in the next financial quarter. Therefore, investor sentiment had been lowering, which by all means I am fine with, because my own personal sentiment is great. I will be topping up this position and average down whenever I can, simply because at the moment I believe I'm down 70% on this investment, and therefore I can really chuck some extra cash into it, build it up, and it is also my highest yielding stock in the whole portfolio. I suspect investors had been taking profits from the stock, and that's why it's been reducing over this time period. I then used my dividend income from Games Workshop plus the remaining cash that I had from my weekly deposits to buy 5 more shares of SoftCare. I currently own 107 shares of SoftCare, and this allows me to really build up this position and hopefully get it to my third largest desired position in the near term future. The share tip of the week is a high growth stock with what I would consider to have lower to medium risk. This stock is a specialty retail store, which actually hasn't been struggling as badly as you may expect, considering they have over 2,400 stores. And just because they have a higher than average volatility, this basically means that as the markets have been dropping, they've dropped by a much more considerable amount, which I believe is near 10% in the last week. This means that this could be a good time to start averaging in and build that position up, as they are a high growth stock with a lot of opportunities. And they are basically a specialty store that engages in the retail of sports, fashion wear, outdoor clothing, accessories and equipment. This stock is in the FTSE 100, has a market capitalisation of £7.3 billion and is named JD Sports. I personally feel that the longer the pandemic lasts, the likelihood of a second national lockdown is increasing. JD Sports do have quite a high exposure to the UK, and therefore I feel that more people in this lockdown and the longer this pandemic ultimately lasts means that people will more likely want to be out of the house. Therefore, I feel that the money that would usually be spent on clothing to impress others and socialise, such as places like nightclubs that are still closed, this money will be allocated to sportswear so that they can also look good, but also go out and exercise more and get outside of the house ultimately. So therefore, I feel that this is a trend that may start to appear should the pandemic worsen or continue significantly longer than most people expect. And whilst I'm not going to be investing in it personally, it could provide that opportunity for you. But by no means is this a high value opportunity. But if we do see a second crash, for example, then this could definitely be one to watch. After all, JD Sports Fashion have got a great balance sheet with low debt. They also have high amounts of free cash flow, and in the last 5 years would have returned shareholders with 293% with dividends reinvested. Really not bad for a retail store that likely will see less footfall over the next few months or as long as the pandemic lasts. If you're interested in my Barclays stock analysis, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Stay safe.